restart the recording. And what's going on with my audio? Okay. You guys can hear me. Okay, that's good. That's good. All right, let me start sharing my screen with you and get us going for the day. What a day it is. All right. Oh, come on, fix this thing. When you put up Zoom and you share stuff, it like throws up all over the screen. Let's see if I can get you instead of a big calculator there. There we go. All right. Real pro here, guys, at work, so bear with me. I don't want to see my own mug. So I hope you're having a great trading week so far. And yeah, I think it's a good thing to take a little bit of froth. Looks like we're going to bounce a little bit. We've got about 66 points off the SPY or the SPX, I should say. And we are at the, let me maximize this here. And yeah, you can see that we're right at the options applied expected move. We kind of overshot it a little bit, and now we're back above it. So well, let me get rid of my mug too. Who needs to see me? Nobody. Let's see if I can get rid of it. All right. Zoom, show me my meeting controls. Doesn't want to. Okay. Let's see here. All right. Yeah, you guys don't need to see me anymore, so you know I'm here. Okay. So yeah, we hit the options implied expected move, which was around 67, 35, went down a little bit, and we came back. So as you can see here, I'm gonna squeeze this in a little bit. Our MACD on the daily went negative, and we are now in the neutral zone for the relative strength index, right around 50. And so after making a new all-time high last week, we are pulling in, albeit reluctantly and slowly. But yeah, yesterday was a kind of a dead cat bounce, but the topping tail was the tail of the day. Definitely a cat's tail there, bouncing, and then here we are today with a little bit more downside. And yeah, there's just a lot of signs that we need to take off some of this froth and set ourselves up hopefully for a decent December or latter half of November for our traditional year-end rally. Hopefully, we're still going to get. MACD on the weekly now is looking like it might want to flip over. We've backed off the overbought 70 level on the relative strength index, RSI. And then if we look at the monthly, we are still inside last month's bar on the SPX here. MACD solidly positive, still overbought on the monthly, though we're inching closer to the 70 level here. We'll see a sign of bullishness will be that it holds the 70 level and it stays overbought. But this is a monthly time frame. It's going to take a long time for this to form, obviously, till the end of November. So this is a candle in formation, but you can see here that on the weekly, we have stopped one-time framing to the upside. And one-time framing to the upside is after this bearish bar on the week of October 10th, each low of each week's candle was higher than the prior low. And last week's low was 68.14, and here we are at 67.36. So we have stopped one-time framing. And usually what you see is the one-time framing stops on the lower time frame and it propagates through to the higher time frames. And not one time framing anymore is a signal of some change. And whether it ends up propagating to the monthly chart depends on whether we close November anywhere down below 65.50. And that's a closing, not a visiting it. We need to close below that to see if we're definitely stop one time framing. I don't think we're going to get down there, but we shall see. But still, bulls have the edge in the long term and the intermediate term. On the short term, we have a bearish parabolic stop and reverse stop. That's a volatility stop. Chandelier is still positive, and it's we're right on it right here. So if we break that and close below today's options implied expected move, let's call it 67.30 or so, then that will break the chandelier stop, which is another type of volatility stop. Down here, these blue dots are an ATR trailing stop, and that's right at the 50 days. So I would expect a bounce there if we can't hold up around here. Flipping to the NDX, we can see similar picture, bearish PSAR, bullish chandelier. I don't have, well, I do have them on the weekly, but here we go. MACD flipping negative again, neutral RSI, and you'll never believe what I'm doing here, guys. Doing this, and I also have, I'm supposed to take, I think I have my ethics hour, so I got to take my ethics education, and so I got to kind of pay attention to the signals there. I've taken this course before, so I'm just I did the course and I didn't get the credit for it for some reason. It didn't register, so I got to register it again. In any case, the NDX here is MACD is positive, not quite looking like it's going to flip over. And then RSI is down below the overbought into the 65 level. So room to move down to the 50 level. And then we've got the monthly, again, looks just like the SPX. Here we have a series of candles and all to the upside. And now we're seeing a little bit of red. MACD solidly positive, still overbought, although it's starting to come into the 70 level on the RSI. So NASDAQ looks pretty solid. Here's the options implied expected move. And we are bouncing off of that as well. So we may have put in the low for the day today, which is one of the reasons that I put out a QQQ spread trade. And in retrospect, I probably didn't make it wide enough. I should have made it probably 20 points wide, but anyway, we'll spend $5 to see if we can make double our money on that within the next couple of weeks. I think we can do okay with a bounce in the NASDAQ over the next coming days. Third one we want to look at, as we always do, is the Russell 2000, the small caps, which is really not as good as the other two, still is. MACD has been negative for a couple of weeks now, and it continues. We're still above the zero line, so that's a good sign. We are now heading for oversold. We're below the 50 neutral level at 45 on the relative strength index. And then we have on the weekly, we're definitely giving back this 1 week here, these 2 weeks here, above, and then coming right back down. We are also at the options applied expected move for the week, right around 24, 21. MACD looking to flip negative, and or having a fast line cross over the signal line. And then we have RSI at the 59 level. So it has room to move down to the neutral level at 50. And then here we are on the monthly, nice uptrend, and we're just getting a little bit of red. We made a new all-time high last month, and MACD is still positive. We're at the 60 level. We never even threatened to hit the overbought level, and it's kind of disappointing. Interest rates go down, and the rut doesn't underperforms, and interest rates go up like they have this week, and the Russell 2000 still underperforms. So I'm not sure what it's going to take to get these small caps to get in gear, but we have a bearish PSAR, still a bullish chandelier. There's those dots right there. The green ones are the chandelier dots. We break those on a closing basis. Then we will probably edge down here to about the 2400 level on the Russell 2000 at least. So next thing we want to take a look at is the VIX. And hey, we're at the 19, not quite 20. It's, for a day where we're down about 60 points, it's a pretty mild move on the VIX, only 7.5%, barely 7.5%. And we've already backed off. I guess we hit the 20.31 level. So love to see actually a couple of days where we close above the 20 level. That would make for some good buying opportunities. But the long-term average of the VIX ever since its inception, about let's call it about 30 something years ago, is about 19 and a half. So we're right at the long-term average for the VIX, 19 and a half. And so what I like to tell people is that if you can get a VIX above 27, 28, that's one standard deviation move. And that's grounds for buying stuff long-term, putting them away, and much more likely than not. I can't remember what the percentage is, but 1 year later, I don't think there were any instances where you lost money if you bought at a 27 VIX. And then the next level, which is a 2 standard deviation move, would be around the 35 level. That one's kind of a load the boat kind of thing, where there's no chance you lose money if you hold on for about 12 months. So for your long-term accounts, that's a consideration. And I definitely subscribe to that when I put money aside for clients to invest in their portfolios. But you can see here, VIX still relatively mild response here. And if we take a look at VVIX, so not a lot of concern, and we'll look at the VIX prices in a second. Yeah, no panic at all. I mean, VVIX is above the 100 level where we start to pay attention, but not above the 110 level where it's kind of like get under your desk and rock back and forth in fear. Not really, but this is just a very mild, it would seem, sell-off, because I would expect to see, if institutions were scrambling to hedge really in a serious way, the VVIX would be at 110, and here we are at 106. So let's take a look at the VIX pricing of options, see where they are. I looked at them yesterday. I think there were 2 or 3 times on the puts. We have a VIX expiration coming up. Let's see here, close these up. We have VIX expiration coming up in about 12 days, which means that we have a VIX futures expiration in 13 days. And so we're at 1935, let's call it 19 and a half. And we look out to the 20 and a half calls, and those are pricing at around $1.40. Go to the 17.5 puts, and they're pricing at 42 cents. So 3x. So edge goes to the bears. So if the thinking going again, I know I repeat this every week, but there are also always new people on the webinar. The thinking is, if you look $1 out of the money from where the VIX is, 19 and a half to 20 and a half, you see what the price is, and you look at the comparable puts equally distant away, and that'd be the 17 and a half. And if the calls are pricing out higher than the puts, in this case, they're about 3 times as expensive. It just means that more people are buying calls. There's more demand for calls than puts, and therefore the bears, market bears, get the edge. And if you were bullish on the market and bearish on volatility, you would buy these puts to try to make some money and benefit from a decline in the VIX, which is what you get when the market is going up. All right. So not looking like there's it's not like these are 10, 20, or 30 times. It's just the edge goes to the bulls. And again, this is one data point. Let's take a look at the VIX futures and see the configuration of the VIX futures. And so the VIX contract that expires in 13 days says we'll probably be right around where we are now. I mean, spot VIX is at 1931. This VIX contract that expires in 12 days, 13 days, 1986. We go out to the December expiration, it's at 20, then 21, 21, 76, 22. So VIX futures, the construct of them is in a normal fashion, and it is as you would expect that the VIX um, futures should be higher as you go out further in time because there's more uncertainty, there's more potential for events to happen. And so we call this that this is normal contango for the VIX, that the farther dated contracts are more expensive than the nearer dated contracts. When you get the closest contract to be higher than all of them, that's a condition called backwardation, and backwardation means that there's more immediate fear here and likely more downside, and that's a more bearish signal for the market. And so far, we don't have that here, and that's a good thing for the bullish case. All right, so let's take a look at the expected move. When we started the week, according to what I mentioned in the video on Sunday, you did watch that, right? um, we had a $106 expected move, somewhere around there, into Friday. And if we come over here, here we are with, let's call it, what, a little bit over 2 hours left and a day. And we have 60, almost 61 points left into tomorrow's close. So if you say that on $106 move, that's basically 21 points a day on average, but yet we only have just over a day and we have 60 points left. I would say that we're packing in a lot of volatility. And, you know, if you look at an intraday VIX chart, let me maximize this and get rid of that and that. Give me my screen back. You know, let me see if I can kind of do an hourly chart. You know, better to show you on the S&P futures, but if you look at what happened overnight yesterday, I mean, we traversed about 100 points intraday, and here we are. We got as high as 68.43 here. Here we are down at 67.65. You know, we had a 100-point expected move for the week, and we're seeing that kind of movement in a day. So don't be a seller of short-term options, I guess is what I'm trying to get at here, because basically you're going to get run over if you're selling short-term options. Now, on the other hand, you want to be a buyer of short-term options because chances are with the market moving back and forth as much as it is, you'll be able to make some money. But if you sell short-term options thinking you're going to make money, with this kind of volatility, you're likely to get run over. So let me pause there. And if anybody thinks that I talk too slow or too fast, just let me know either in the forum or what have you to see. No questions. You guys can still hear me, right? Okay. No questions at all. All right. We'll keep it moving. So thank you guys for that signal. Let me bring up our current trades, and had to, I know you're not seeing my screen just yet, but for some reason, okay, here's the trade list. And let me share that with you guys. For some reason, my monitor configuration messed up. just before we came on, and so I lost the tab. Let me bring that up here. Where is the, okay, here we go. I'll bring up Thinkorswim. Let's go through our trades and maximize this. Lots going on today, guys. Lots going on. All right, let's make this smaller. No, I didn't want to do that. Jeez, it's finicky. They must have added a new column, the developers. Days on. Come on. All right, let's see if we can. What's this? Okay. I don't know why I got a split screen and Thinkorswim, but we'll deal with it. Oh, mouse is being sensitive. Okay. So you're not seeing my screen, my Thinkorswim screen. What's going on? Let me share this again. It lost all the sharing. Interesting. All right. Okay. Now we can see it. Here we go. Sorry about that, guys. Hate when that happens. All right, we've got our trades and sort them properly. Okay, so one of the new trades we put on this week is the Citibank short put. We're up about a whopping 9.5% almost on these. We sold the 95 put in November. Still holding up. It's just going sideways, not doing anything wrong. MACD is positive. So just let this decay away. We love the sideways actions when we sell a put. So we'll just give this time as we get closer and closer to expiration, which as of tomorrow, monthly options expiration is only 14 days away. All right, now here's Costco, and I don't know what the heck is going on today, but look at this. Look at these long tails, man. I mean, that's just crazy. The stock was down about $25, maybe, no, $26, $27 on the day. And, you know, if you're watching this, and I get it that you would have been like, what's going on here? We're gonna head down to 880. We're gonna just trip this up, but we're still up 33, 31%. You know, I think Dan mentioned it, or maybe it was Scott. I mean, the retail stocks, they just have not participated. And this is historically the weeks leading up to Thanksgiving is when these retailer stocks start to rally. But I've been reading some research reports, and I don't think they're expecting a great holiday selling season for various reasons. But we shall see if these experts turn out to be right, but maybe that's what the retail stock prices are reflecting. So you look at Target, gave up the entire rally. Walmart was up to almost 110, gave up that rally. And here we are, Costco. I didn't see any news on it, but here it's down 13 bucks, but we're still far from our short strike. And I still like Costco no matter what. But boy, if you can get Costco under, you know, 875, grab some, hold it for the long term. I think it'd be a good, I wouldn't call it a bargain, but it would be definitely something that's good for the long term. Next in line here, Hormel. And this is our long-term consumer staples play. Been holding up pretty good. It's trying to bust a move to the upside. I still have a lot of confidence in this, guys. And if you're not in it and you want to buy into it, I would say, yeah. I mean, the 25 calls certainly would work. But if I were setting up a new position, I know we talked about this last week. Maybe do the 23s closer to the money. That's what I would do if I were starting a position in 2027. But again, this is a counter trend trade. This stock is in a downtrend. Consumer staples are out of favor. So this is a very long-term hold. And if you were in this on the 14th of October, you would have collected a whopping 29-cent dividend. So this stock has a 5.34% yield. And if you buy the stock instead of the options, I'll never know. You won't hurt my feelings. And I think you could sell covered calls on this. So you could come over, let's see, June, um, December. Yeah, I mean these are pretty juicy. For a couple dollars out of the money. Let's go to January. Give us some time. Yeah, this is about 2% of the underlying. You could sell what's this, a 24 Delta? Not bad for about 40 cents on a $20 stock. Yeah, not bad. Anyway, we're playing this deal with a January 2027 calls, and we sold the 20. We were doing it with the 25 calls, and we sold the 23 puts to do this. All right, IWM, as I was alluding to earlier, boy, did I pick the right index or what to bet on in terms of a rally back when we did this. So this one was, we bought a call spread, the 250, 270 call spread, and we sold a put spread. So far on the put spread, we're safe. We're more than $10 out of the money on that put spread. But definitely we're $10 out of the money also on this call spread. So we do have about 43 days. Yeah, tomorrow it's 42 days. It would be 6 weeks till December expiration. We are right at the 50-day line here on the IWM. So hopefully we can hold it. We're still holding this bullish chandelier as I showed you on the rut. I think I have a stop on here of about where did I put my stop? 239.70. It's not showing up here. What did I say here? Did I put that in there? 239.90. So we have a couple of bucks. I may revisit that because of all these confluence of stop levels. But for right now, we're still in this, and we're definitely not making money. We did take one profit target on this at 641, and now we're down to a buck on these. So we probably should have stopped on these at break even, but here we are. J&J, we still have the covered call right here. Again, the slow trade, and this is kind of a worry-free trade. Basically, you have a deep in the money call, and you're just holding this and benefiting from the decay of the extrinsic premium. So on the 170 call that we have sold on here, and unless you rolled them to something else, that's the November, right? We're in the November one. Let me maximize this. Get out of my way. I'm talking to Zoom with their stupid controls. So the 170 calls, which were short, yeah, the extrinsic value here is basically nil. And I think we should start thinking about rolling these out to December, lest we get assigned prematurely. Not that that would be a bad thing, but if you wanted to, and these are wide, so be careful. So if I was to buy to close these and roll them out to December, what would I collect? Another 55 cents. And given that we have a dividend on the 25th, you can bet that if we don't roll these before the ex-dividend date, your shares will be taken away, and they will, the dividend trolls will steal your dividend. So Sometime in the next week, I'm gonna put through a trade to roll these out to the 170s in um, uh, December. So we collect 55-cent credit. We protect ourselves from an early assignment, because if there's extrinsic value in this put or this call, then they definitely don't want to get you assigned. And actually, now that I'm thinking about it, 70 cents might not be enough to stave away these dividend trolls, because if the dividend is 130 and they have to pay you your 69 cents in extrinsic value, um, they'll do that all day long. So I may have to roll out to January. And yeah, that's probably what we're gonna do. So we're gonna take the Novembers, move them to this January to protect our dividend here. And if anybody still has this play, just give me a thumbs up, will you? I just want to know if anybody in here still has this one, or whether I should continue with it or just close it out. But in any case, even if you've rolled it out to a different strike in a different month, that's fine. But I'll have to check in the forum to see if anybody's really still holding this one. Otherwise, we just close it out. And we did this as an example for one of the, excuse me, for one of the classes that we did. All right. Let's go back to the trades. And why is, okay, maximize this up. That's how I get rid of it. There we go. That's what happened. All right, that's J&J. So nobody in here has J&J. Okay. I don't know how to work the little thumbs up. NVIDIA or MP. Well, MP we closed today. They have earnings, and glad we closed it early. I wish we had closed it earlier, but we were holding on to the 55 level for dear life, but it gave it up today. And we're down at the $52 level, but we closed this first thing this morning. So we took a loss on the MP. Very disappointing, but look at this stock. I mean, it hit 100 back on October 14th and has basically lost almost 50% of its value in less than a month. So talk about momentum and government intervention, and buying into this company is just, and here's, sometimes it pays to pay attention to the daily MACD. When we had the cross here, that was our signal, and should have paid more closer attention to this, because basically it never recovered. A lot of times you get a little cross and then it flips right back up, and that never happened. So maybe we should have set a stop. Well, I think we put this on. When did we put this on? It's closed. So we only put this on 8 days ago. So the MACD was already negative when we did it. Oh well. So one of our losers, bye-bye. NVIDIA. Now NVIDIA is having a day today, um, given that we just not too long ago made an all-time high at 212, we're already down to 189. I'm not concerned about this at all. Let me bring this to the right level. So we closed about half. When we got to half the premium, we sold this for, let me make this a little bit wider. Come on. Why are the columns? I'm just not sure why the cost column is not accommodating all 4 letters. And let's see here. Yeah, so we took off half here. It's at about $1.28. We sold it for $1.91. I'm not worried about this. This is a 170, 160 put spread. We're about $19 away from the short strike. So this one has earnings coming up. When are earnings on NVIDIA? I think that's options expiration week. Yeah, it's got to be there. Look at the implied volatility. jumping from 51 to 61, or 52 to 61. So we'll figure out what we're going to do ahead of earnings, but I still think plenty of time for this one to be fine, and it's still profitable. So, and we've been doing NVIDIA for months, and that's worked out. Well, I guess I waited a day after earnings on Palantir to put on um, a put. I thought we were safe, and by waiting a day after earnings, and I was anxious to put it on the day of earnings. So I said, "No, I'll give it a day," and here we are. We're at the 50-day. Not worried about this at all. We're down 32.5%. So we put on the 165, 145 bull put spread, and that's about $13 out of the money. So nothing to worry about here, nothing to do. Earnings are out of the way. And if this is just normal volatility and positioning for year end, again, Palantir will do just fine. And if this is a name, again, you can't look at it in terms of the price multiples on this. It's ridiculous. But I believe that this will be a $300 or $400 stock within a couple of years. So use the dip, buy some, put it away for a long term, and I think you'll be glad that you did, even though all the talking heads on TV will tell you how outrageously priced it is, and indeed it is. But this is a stock of the future. You'll thank me for it. PayPal. All right, so this has been choppy as hell, and we're down on our play. This is a January. We bought a call spread and we sold a put spread, and I guess I never went back and filled this in with some explanation here, but we bought the 70-80 call spread and we sold the 65-55 put spread. So we're still above the short put strike, and that's okay. I really do like PayPal. Hopefully I gave us enough time. That's about 71 days from today. That's just a day over 10 weeks. But we are down on it. But when we look at the chart, I mean, it's holding up relatively well. It had a nice day yesterday. It's holding the chandelier stop. Well, not the chandelier stop, but what am I looking at here? No, this is just the options implied expected move. I don't like the fact that it's under the 50-day, but we'll see what happens when XYZ, formerly Square, formerly Cash App, formerly whatever they used to call themselves, Square, reports earning. I think that's coming up in a day or two. But in any case, I like PayPal. I like what they're doing, and I think we'll give this some time and room to recover for our play here. QQQ is a brand new play that we put on just before the webinar, taking advantage of the pullback here. We really got a little tail coming on the day and recovering. So let's take a look and see. We put this on for about what, 5.25. Yeah, we're up. Woohoo, 4.5% already on here if you got in at the cost. So yeah, I think I had wished I'd put on a $20 wide spread, but if it doesn't work out, we'll be glad. If it does work out, we'll still make some decent money. We can almost double our money on this. So just play a little bit of the recovery in the market. And the other one that I thought about doing was given the SPY is down 836, and if you wanted, you could do it too. I'm only giving us 2 weeks because I don't see this as being a big bearish move, but you could do a 615, 635, or a 615, 625 call spread if you want to do a $10 wide. These days, the Qs and the SPY is moving $10 at a time. And I'll point out that the skew is not in our favor. So look over here, the implied volatility of the call we're buying is around 21.8%, but the call we're selling is 20.24%. So the skew is not in our favor in this particular um, uh, spread, and neither is it in the Qs. And all this tells me is that uh, we're paying just slightly more than we would have if we had the normal skew where the regular skew where the farther out options had more um, volatility than ones we're buying. Another way you could do something here to take advantage of the skew as something that we've tried and I've taught in the past, doing a back ratio. So if we sell the 615s and buy, let's say, two of the 628s. All right, this is a bet that we would get back and beyond 628. We collect $1.02 credit, but what happens with this back ratio is that you have a little valley of death between the 615 and the 628s, and which means that um, if SPY were to close between 615 and 628, this would lose money. But anything over 628, what you have here is basically a short call spread or a bear call spread embedded with a bull, embedded with another long call. So we need to get, if you believe that we can get over 628 within 15 days, then you can definitely make money on this. And you don't have to wait for expiration to do this. But given where volatility is right now, I'm not recommending this one because what happens here is that you have 2 times the theta on the long call versus the short call. I would be waiting for volatility to calm down a little bit to do this, because what will happen is that you'll start, if the volatility starts coming in quickly, you'll lose value on 2 times the options here versus one option here. And so you not only might get screwed by the valley of death between 615 and 628, but also a little bit of the decay. So maybe not such a good idea. I still like the call spread 615, 625, or you can construct anything you want in between in terms of a spread level, depending on what your risk is. All right, enough about that. Sorry. All right. But we backed the Qs. That's what we took. All right. SPY. Nice to have a hedge, huh, on a day like today. So we took a couple profit targets, pretty much at a good time. So we sold at 975 and 940. They're down to 860. We're going to hold on to the rest of these. We have until the 28th of November, which is essentially 3 weeks from tomorrow. So we're going to keep this hedge. And I'm going to try to look and see where I might want to set my stop on the rest of these so that we don't give too much back. But first, I want to see signs that the market is reversing to the upside before I do that. But you do whatever you have to do to protect the rest of your profits depending on your position size. So this has worked out pretty well. So we already doubled our money on, let's call it 1/3 of the position, since we've been taking off 1/6 of a position. The other one that we have is a SPY put in January, the short 575 puts, and we're still up about 32%. We used this sale of this SPY put a couple months ago to finance a different SPY long put spread. So hopefully you guys are in this long put spread and helped ease a little bit of the downside that we got today. TLT, doing what TLT does. And what does TLT do? It's up, it's down, it's up, it's down, it's up, it's down. And when we've been doing this since last year, selling puts on TLT. And no, it's not a huge money maker, but we've made money every time we rolled, so that's a good thing. So we took profits at about the halfway point, 28 cents, and now it's back up to 53 cents. I don't think we're going to see um, much more weakness here. I believe that bonds are going to turn around and bounce right back up. They went through the 50-day and now they're trying to get through it again. But quite honestly, I don't find the 50-day to be that much of an issue for bond instruments like the TLT. 200 days down here at 88. We have an 85 short call, so we're still quite a bit away from the short strike. And this one's in December, and probably should have rolled it back when it was 28 cents, but that's okay. We're at 53 now and still below our cost basis of 60 cents. So we're still up about 11.67% on the remainder of these. Last one we have, long-term play, XLP. This one is our long-term consumer staples play. So weird that we have two long-term plays that are both in the staples space. That's the Hormel and the XLP. You can see here that we basically bought a straight call, the January 80 calls. Still like this play. We're down 27% on it. If I were opening a position here today, and make no mistake, this is in a downtrend. It has not shown signs of strength, but if we go into a recession, and I shouldn't say if, because I think next year we're going to see something of a recession. All signs point to it, but I think that next year we will go into some type of recession. So here we go with we have the January 2027 80 calls, and those are right here. If you wanted to, if you were starting a position, I would buy the 75 calls at this point, right at the money. And yeah, I would go for the 75 calls, but certainly the 80s are still fine. They're a 43 delta, nothing wrong with that. But if I were starting fresh, I would buy some 75 calls and start this position. But again, patience is required. This is not a 3 or 6 month long play. This is at least a 9 to 12 month play on the recovery of consumer stable stocks, which tend to outperform the general market if we go into a recession or we see a bear market of sorts. And of course, everything suffers in a bear market, but consumer staples to a lesser extent, because we still need the Procter and Gamble's, the Cloroxes, and the Walmarts of the world. So we need our supplies, we need our utilities, we need to go see the doctor. Similarly, XLV, which is the healthcare, is another defensive sector. So let's see, we might have some questions here. That's all our positions, guys. And I've been looking for other stuff, but as you know, we've closed several plays this week and not for profits. And that's the way things go in the market like this. But I am always looking for stuff for you guys that have a good probability of working out. But I have to say the fact that we haven't been able to harvest profits on stuff, and the ones we have been reluctant. It just tells us what kind of market we are in. Can I, Randall asks, can you explain what you're referring to a chandelier and how to interpret that pattern? So a chandelier stop, and it may not be a study in, this is someone else's study, and I think this is an Alexander Elder thing. So if you Google or AI chandelier stop, I think you'll get the full explanation of it. But it's basically, a lot of people like to do trailing stops, and I use the ATR trailing stop. That's an indicator in Thinkorswim. Right there, you can use that. That one's a good one. Chandelier stops are something I started using many years ago, and this one has a little bit of volatility built into it to kind of vary where it is, but is that the palette? No, but Bear Chandelier. So the chandelier is right up here on this XLP right now. So about $78 level. But um, I can't do it justice in terms of explaining it, but it's a volatility based stop. And I think it was popularized by Alexander Elder. He's the author of several trading and money management books on trading. So take a look there, Randall. And this is not in Thinkorswim. This was someone who coded it and shared the code with me to use in Thinkorswim. So it may not, and I don't even know if I can still get it if I moved off of Thinkorswim, but I think if you Google it, you'll find a way. Maybe even TradingView might have that one. So much for that. So Randall asks, why is it not a good time to sell short-term options like 1 week bull put spread? I would have thought we get elevated premium. Who's saying it's not a good time to sell short? Did I say that, or did someone say that? So Amazon, 14 November, sell 240, 230. Let's take a look at that. Um, if I can type. There we go. All right, let me. Okay. 240, 230 put spread. Okay. So first thing I will say is, so you're going to collect $1.74 for this put spread, which isn't bad, which is less than 1/3 of the width of the strikes. And I do that, but take a look at the implied move into the 14th. And the immediate reason why I'm not a big fan of doing at the money or in the money put sales is right here. So we're expecting a $10 move into the 14th. So we could get down to the 235 level, and we're already $5 in the money there. And remember what I said a couple of times is that not only is, the 235 has a 19% chance of closing out of the money, but it also has 2x that amount, 2 times that amount of being touched. So if I were doing a put spread next week, I wanted to do a $10 wide put spread. I'm not going to collect 1/3 of the width, but I would do the 235, 225. I'm not going to collect this much, but at least I am putting myself beyond the options implied expected move, putting the odds in my favor, and getting beyond the expected move if I don't want to have the possibility of being put. If you really want to sell something and get 1/3 of with the strikes, you're going to have to go right at the money, 245, 235. So that's $3 you're collecting. Chances are that you will not make the full premium, but because you are basically have a 68% chance of this closing at the 235 level next week. So what I prefer to do is give myself a little bit more time so I can adjust out of this. Nothing wrong with the 14 November, but here we have a $14 move into November expiration. We have much more liquidity in terms of open interest. So the 240s have a 35 delta, 235s, 25 delta. I don't like the half strikes as much. They don't have as much open interest. So I could see doing the 235, 225s in Amazon. I like that. Collect $1.47. Yeah, I do have a possibility of, it's a 25% chance of being in the money. But to go outside and do one standard deviation, I would do 235, 225.5. And that way I know that I have a 68% chance of keeping this entire premium, not being threatened to be closing in the money. But again, 68% chance isn't 100% chance, but that's basically how I would think about this. If I wanted to do short-term premium selling, I would give myself a little bit more time and a little bit more room to be right. But again, you can do whatever you want as long as you understand, where your stop is. And it's like we discussed last week. Um, whether you're trading stock or whether you're trading options, your first stop, and I know the charts are really important and we live and die by the charts, but if you're an option trader and you're in this class or in this webinar, okay, your first reference should be the chart, but it should also be the expected move. And I'm going to keep drilling in that one into your head every single week, because this is where I start all my trades. And where I get into trouble is where I forget or ignore the expected move. And so if you're going to buy Amazon today at 245 and you're going to hold it, and you don't know that in 1 week you're going to buy, say, 100 shares of Amazon, and in 1 week it's expected to move $10 up or $10 down. And if you have your stop somewhere less than $10 a share and you're looking to hold this and make yourself a few bucks on it, if you're not aware that it has a $10 move, then you could be quickly down $1,000. And maybe the chart shows that to you, maybe it doesn't. But when you're doing stop placement, always consider the expected move, because the stop placement should take this into account. So once you know that Amazon can move $10, you can position size for it, and therefore know that within a week you'll possibly move 10 points. And if you're okay with $1,000 loss on a $100 share position, great. Same goes for options. You want to know where the stock is moving to. As we discussed last week, should you buy a 255 call next week? I would say, heck no, it only has a 21% chance of closing in the money. All right. Sorry, I went off on that one a little bit, but okay, that one was answered. Uh, there's not to sell short. Oh, what I was saying is that if you're, yes, you heard me say that when you're looking at short-term options, when you're looking at like the indices, and that's what I'm referring to. What a lot of people like to do is go out and sell SPY or SPX or QQQ puts, or even naked stuff. Could you go out and uh, sell short calls or short puts on the indices? Sure, but the fact that they're moving 2 and 3 times the expected move tells me I don't want to do that, because the advantage is for me to buy those particular options rather than sell them, given how much they're moving and how much volatility there is. So I'm not saying don't sell short-term premium. I'm just saying don't sell short-term premium on the indices, because you'll probably get run over. And your single stock, as long as you're taking into account the implied moves, then you're good. So Amazon 239 is the prior high. Let's assume this level will act as support. Yeah, you can. So, but options tell you that we could still move to 235. And I trust and I hear what you're saying. I'm not denying what you're saying, that there is support at the 239 level, right down here, or right over here, and looks like we're getting it today here, right down the 242 level. But I always, you know, when you think about options and you think about how they're priced, and it's people, and then people buying and selling, and putting real dollars. So I trust the option pricing and the expected moves more than I trust the charts, because the charts are basically trading with somewhat of the rear view mirror. You do not have the benefit of foresight with a chart. And trust me, I use charts in everything I do. So there's nothing you can tell me about working with charts that I don't already know. And I know how to draw trend lines. I know Fibonacci's. I know Bollinger Bands. I know all the junk that we use. Anything you tried and used, I've done it too. And while this chart looks like spaghetti and a whole mess, and I really do need to clean these up, but what I'm saying is that I look at the charts, I see where support is, but in expected moves, I trust. So I ought to print some hats or shirts with that statement. In expected moves, I trust. And if I'm okay with this expected move, then go forth and trade. That's all I can say. So hopefully that cleared it up or made it clear as mud. Answer live, done. Any difference between expected move or active true ATR? There, Joe, there is, because one is based on option pricing and one is based on volatility. So you can see that I use a variety of tools at my access, and I put them on the chart because I want to know where they are. So something in ATR trailing stop is based on volatility. So is the chandelier, and I don't know as much about them, but I always, my final stop before putting on a trade is the expected move. And so the active true I don't know what active true range is. Um, I thought the A stood for average and true range. Maybe I'm wrong, but in any case, I use both. So those are the questions we have so far. And let me switch gears here, take a sip of a Diet Coke, and got a short one for you today. We're going to kind of continue where we left off last week and talk a little bit about the options volatility and you, or volatility risk and you. And where we left off last week is talking about some of the stocks and the effect of option pricing. Now let me get rid of this. And when I say I got to get rid of the Zoom controls, they just keep reappearing on the screen, and I got to get them out of my way. So when you think about option pricing, and this goes back to my gospel of respecting and knowing the expected moves. And, when you're thinking about stock prices, options are not just predicting stock price movement. They're kind of dictating it. And you can see it all the time when you hear about gamma squeezes or short squeezes. And so the other day, here's twelve thousand calls on Amazon, since we're over here already. 846 calls traded on Amazon in the what strike is this? I keep covering it up with my huge calculator. Let me make it smaller. 12,846 at the, Jesus. Sorry, guys. Is that the 240 strike? 250 strike, November 14th. Let's take a look at this week's. What do we have? We have 29,000 calls traded on Amazon today at the 250 strike. Granted, it's only 40 cents a piece. All right. So when you see 29,000 options, okay, multiply that by 100, that's the same as 2.9 million shares, because every option contract controls 100 shares. So when you see how much at just one strike, here we have 14, 15,000, we have 12,000, we have 12,000, we have 6,000, 16,000. Okay. Let's go to the SPX. Okay. Some people call it the mother of all products. Let's look at tomorrow's calls. All right. These are the big boy options. And I used to trade them. I don't anymore. Spreads get too wonky and wide. So I stick with the SPY. I like the fact that these are cash settled. You can't be assigned. But they also came up with if I can remember the symbol, a miniature SPX. But the SPX is basically like one option is worth like 1,000 shares of SPY. All right. So if you're buying a call here in the SPX, and look at what we have 2,896. Okay. So 208,096 times 1,000, just in that strike, that's the equivalent of 3 million shares of SPY traded. And what happens when somebody buys those calls? There's a market maker that has to sell it to them. And so market makers make their money mostly from the bid-ask spread difference. Okay. So if they're selling out 2,901 calls, they have to hedge their position. What do? Well, they have to basically, if they're selling the calls, they have to buy S&P futures to keep their deltas neutral. And if they're selling them, then they have to, if they're buying them, then they have to sell S&P futures to keep their deltas neutral. So when you get a stock, and I'm trying to think what stock it was last week. I think it was Grab, and something I saw. And it was ahead of earnings. And let's see if that translated into open interest. But no, not much. So somebody was buying the 6.5 calls on one day. This had an open interest. And keep in mind, guys, the open interest is how many option contracts were open the night before. And so the volume you see here today doesn't translate into open interest either plus or minus until the day is closed and settled and they figure out how many new net option contracts were closed. But at the time, this had an open interest of about 3,500 contracts. And I noticed on one day, 180,000 of these $6.5 puts were traded, and they were bought at the ask. And at the time, they were only like 20 cents, 20, 25 cents. So somebody went to an option that had 3,500 open interest and bought 180,000 calls on Grab in one day. And you notice that because it's big volume. And I happen to own some share of Grabs in my long-term account. Obviously, earnings came out, it gapped down, and this didn't pay off. And now the open interest is only 42,000. But imagine 180,000 contracts times 100. That's 18 million shares of the stock. And that's basically half the day's volume in one transaction. So when I say that, option prices are not just predictive of stock price movement. Option prices dictate stock price movement. So when you're looking at things, keep that in mind. Now, the other thing I wanted to kind of share with you regarding what we're talking about is implied volatility is one thing, okay? And we look here, let me go to something more liquid, like Apple. And you can see for every expiration, you have an implied volatility and an expected move. And so depending on what your time frame is, at all times, you know what the implied volatility is and what the expected move is. So let me think of here, we already had earnings in Apple. implied volatility is the same. Let me try to think of who has earnings today that's significant. Anyway, what I'm trying to get at here is um, knowing where Apple volatility lies on average is also a good clue. So it's one thing to know implied volatility, but when you come down here where I'm pointing to, I got to learn to use the little marker in Zoom. Um, Knowing the IV percentile is more important than knowing the implied volatility. And the IV percentile tells you where Apple is trading relative to itself when it comes to its own implied volatility. And so you want to know when volatility is elevated. So if the IV percentile on Apple is at 50%, that means it's right in the middle of its range. Look at the implied volatility high over 52 weeks. It was 71.2%. It got as low as 18%. And so what this is saying, where Apple is trading now, when you look at all these series of weekly and monthly options, it's trading at the lower end of its percentile, 15%. And so this tells me that Apple options are trading with below average relative to its history of trading. So the implied volatility here at 26.02% is in the 15th percentile. Now, when I'm looking to sell options, I don't have to look at 50 or higher to sell, but I like to look at least 20 to 25 before I consider it a good candidate for selling premium. But what I really want to do is sell something with maybe in the 70th or 80th or 90th percentile. Now, those are juicy options. And for a lot of these stocks that have that, they usually have earnings or some type of binary event. You know, if they're a biotech, they have an FDA announcement pending or what have you. But while I'm on this page, I want to bring your attention to, you know, this option statistics. And I apologize if you don't trade on Thinkorswim. And I don't know if the other platforms have it. I know Tasty Trade is getting there, but they still don't have all these stats. But here's where you can get a lot of information about what's happening with a stock. So more information than you ever need. You know, today, 674,000 contracts on Apple have traded, and that consists of 402,000 puts, calls, and 271,000 puts. So clearly, calls are in demand. Okay. The other information you can glean from this is, all right, of these 403,000 calls that traded, obviously Apple is bullish in a bearish tape. 141 of them, somebody just bought them at the ask, 141,000. Basically, 34% of them were bought at the ask, 30% were traded at the bid or below, or somebody did what I usually do. I try to get it right at the mid, so 34%. So one third, one third, one third. So when you see the traded at the ask or higher at 40% or more, you know that these calls are in demand. Same here with the puts. Most of them traded basically at the ask or above. So somebody said, put in a market order, I'm buying these puts. And somebody basically put a bid in and got it. And 26% were kind of right between the markets. So the other thing I want to bring your attention to here is the sizzle index. And the sizzle index tells you how much option volume is trading relative to the last 5-day average. So in this case of Apple, the sizzle index is 1.085. So basically, we're trading average volume of options compared to the last 5 days. 1.085 is not a big deal. So the call sizzle index is about on par, 0.95. Put sizzle index is a little bit more heavy, but sometimes you'll see 3, 4, 5, 10 to 1 in the sizzle index when things get hot and heated in terms of a stock. So something I just wanted to point out. But how do you find the stocks that have the high IV percentile? And one way to do this, and I don't use a scanner much in Thinkorswim. I'm not a big fan of scanners. Um, you can get lost in them and what have you. But if you're someone who likes to sell premium and you want to search for options with high IV percentile, so you can sell premium on them, because obviously, if they're trading in the upper range of their uh, implied volatility, that can generate a lot of extra dollars for you in terms of selling. So what I like to look at, I like to look in the weekly. So Thinkorswim has a whole bunch of public watch lists. And so over here, you can look and pick the weekly options here in this list. Okay. And then from the study, I picked IV percentile, so volatility, and I said pick IV percentile, and that's what I did here. All right, and it said give me anything between 70 and 99. Well, let's start with 90 to 99. So among weekly options, because I know a lot of you are weekly option junkies, give me anything between 90 and 100 percentile. So now there are about, I think, 600. I'll hit the scan here. So there are about 683 stocks that trade with weekly options. Okay. And you can see here that there are 4 stocks with weekly options that are trading with 90 percentile or better volatility. I don't know this one. I know Groupon. EMB is bond ETF, QXO. So let's expand our universe a little bit. I think Groupon has earnings. If I click here, yeah, they have earnings after hours. So if I um, trade, okay. So here's Groupon. Wow, this must either reverse split or this has rallied pretty good. That must have been a big reverse split because this used to be a $2 stock. All right, so look at the IV high, 135% and 48% here. So right now it's IV percentile is 95. So let's look at some of the call. I mean, go out. What's the implied move tonight? $4.41 on the stock. And so that's 23 bucks. So just by seeing that the market maker move here, this is what you see, MMM, that's what expected is the expected move plus or minus $4.41. So a 19, that takes me out to 23. And normally when I look at one standard deviation out, I get a 19, 20, 21 delta. Here I'm getting a 36 delta. That tells me that the volatility is jacked. So if you wanted to sell the $1 call here, and I wouldn't, given the volatility and the short time to adjustment. Well, no, it's November 21st. It's not tomorrow. I thought this was tomorrow. I'd actually give myself a little bit more room. I'd double if I were going to sell a call on this and I wanted to pocket some premium, I'd probably double the expected move and sell something like a 28 call. I'd feel okay. And that says a 95% chance of not hitting. Well, I better check myself because the expected move into November 21st is $5. So better to go out the 29 or the 30s. So let me go back to the scanner. But you can see here, IV percentile 95. And this one is trading with 50% higher than normal volume. So somebody's into Groupon. Let me expand this and go to 80 and scan. Okay, so now we have 16 of the weekly options trading with implied volatility percentile greater than 800. See if we recognize anything here. ConAgra Brands, they've already reported as another consumer staples. That's a candidate. Ethereum, Galaxy, Kimberly-Clark. Now this one is another consumer staple stock that was been hit hard. Let me take that to the chart. Ah, there we go. I bet the chart. Yeah, look at that. It looks just like any other consumer staple, but KMB doesn't have a very good liquidity, but I think earnings are out of the way. They've made their announcement on the acquisition. So let's see if you wanted to do a put spread and something like this. Yeah, it's either liquidity really, to say it bluntly, stinks. You could sell a 95 call. What is the IV percentile is 83%. What if we go out to December? Do we get anything better? Well, yeah, we got a little bit more liquidity. You could do a 95-90 put spread for $1.17. That's pretty good for being $5 out of the money on a consumer staple. So this is how, guys, when you're thinking about implied volatility and you're looking for candidates to sell, or you're looking for clues, for stuff that is really high. It's one thing to look over here and see the implied volatility percentages. It's another thing to know where it stands relative to its 52-week history. And if you see 83%, you know that it's higher now than it's been 83% of the time over the past year. And so you can really find some good candidates when you go to the scanner. Anything else here? URA, that's another good one that we've traded. We can see that URA has gotten crushed from 60 to 47. This is basically almost a 25% move. If you wanted to do a put spread on this one, yeah, you can go, expected move is $8. You go on a 40, you could sell the 40 puts in December. What about November? What would you get? Yeah, if you go to 43, the expected move is $5. You do the 43 or 42s to be safe. This is a good candidate. I mean, not a lot of open interest, but it's decent. If I could get 65 cents for one of these, I would sell one of them if you're okay with owning the URA ETF for uranium. So the whole idea here, guys, is that understanding volatility and that volatility basically equals risk, and it equals whatever price you're paying for the option. So you want to basically look at this stuff so you can figure out what you want to buy, what you want to sell. Am I really paying? And here's the thing with a lot of these, you can see symbols for earnings. These little symbols, they have earnings, SG, sweet green. Sure, I want to pay $25 for a salad, or $20 a salad. They have earnings. And so you got to pay attention. Is the implied volatility or implied volatility percentile higher because they have earnings, or is it just a volatile name? Let's take a look at MSTR, and we'll wrap it up right around here. Yeah, I mean, look at that. It's trading at 16% implied or IV percentile. Um, this used to be in the 50s and 60s, and so it's kind of calmed down quite a bit. It's no longer the volatile instrument that it used to be. What about FSLR? That used to be a pretty volatile instrument. Here it's 24%. It's not that good, but this is a good way if you want to just look at, say, in the S&P 500, look for candidates. You can just come over here to the public list, S&P 500. Let's go to 90 and then see what we come up with. Wow. Okay. Only one name in the S&P 500, and that's CarMax, and this stock is getting really hit hard. I don't know what this company did, but KMX, this would be a no touch. Yeah, it's having another bad day after a bad day in earnings, and um, wow, is that affecting who was the other one? Anyway, IV percentile 95. If I go back and I do 80%, I get many more candidates. 6. And some of these we are seeing. Look at that. Our trusty Hormel is on this list. Trade Desk, they probably have earnings tonight. Yep, they do. FactSet Research. So, guys, this is a way to find some candidates with high IV percentile, and you can go as little uh, as you want to find the right candidates for premium selling, or if you want to just know that some of these things have high implied volatility relative to their history. Let me check if there's any questions, but generally, remember, option prices drive stock price movement, not the other way around. And so paying attention to the expected move and paying attention to the implied volatility percentile and will help you with your trading and getting better fills, getting better picks for trading stuff. So I don't see any questions here. I appreciate you guys showing up today, and I hope you're doing all right with your trading. I'll see you in the forum, and if not, be careful out there, and I will see you on the Sunday video. All right, guys, take care, and I will see you soon. Bye-bye.